how do you determine if the business is community property or a separate property? If the business was started during the marriage, then it's going to be classified as community property. Now, if the business was started before the marriage, it's going to be classified as separate property. However, the community can gain a substantial interest in a separate property business if the separate property business growth was a result of the time, effort, talents of the operating spouse. Now, a business such as an apartment house or something like that, the growth in that type of asset is going to be what we call passive growth. That's growth from just investment value and increase in investment. But if you have a business that's run like a professional practice or any type of business that grows because of the management and effort of the operating spouse, that business is going to have a tremendous amount of community value if you've been married for a period of time. I had a client one time. They started a business while they were living together but not married. They started a business. It was basically a display exhibit business. It was started in the husband's garage. Then they got married and it was still operating out of the garage. Well, then 20 years later, the business had grown to having about 100 employees. And in this case, well over 90% of this business was determined to be community. So the community can gain a substantial interest in a separate property business. Community property means that that's property that is acquired during the marriage. It's divided evenly between the spouses. All property that's deemed community goes in a column on a balance sheet, and each spouse is going to get one half of the community property. When I say each spouse is going to get one half of the community property, I mean that each spouse is going to be awarded one half of the community property by a court. If the business is going to be split up, most typically, we would bring in a forensic accountant. And that accountant is going to determine if there's a separate component to the value of the business, and then also what the community value of the business is. And that's quite a lengthy process. You have to provide these records. You have to provide tax records, payroll records, all types of business records, which will then allow the accountant to determine the cash flow of the business and eventually the total value of the business. And once the total value of the business is determined, then the separate and community value can be determined and allocated. Well, the business is most likely going to be intact post-divorce. So what do you do with a business post-divorce? Most typically, the business is going to be awarded to the operator spouse. That spouse is going to take the business at the value that the accountants determine and that the court eventually assigns to it. So the business is going to be awarded to the operator spouse, and as can happen typically, there may be substantial value in the business, and that will be charged to the spouse who operates it. If the spouse wants to keep that business, they'll have to buy out the other spouse of their share of the community value of the business. So if a business, let's say a business is worth $1 million, let's say the community value is $800,000. The spouse who the business is going to be assigned to will owe the other spouse about $400,000, which would be their one half of the community value of the business. Why do courts want to keep the business intact? The business is what supports the family. The business is often the life's work of the spouse and the business has been supporting both sides of the family often, both the husband and wife. So the business is going to be kept intact. To do otherwise would be to waste it, unless in these rare occasions it could be easily sold. Typically, if you want to keep your business, and the example of the business is worth $800,000, where the community value is $800,000, and the other spouse would then be entitled to one half of the $800,000 or $400,000. Now, most of the time, spouses don't just have that amount of money to pay the other spouse. So sometimes that value is going to be offset by other values. Maybe there's a home with some equity in it, or something, or some other accounts, or other things like that, other investments. So if that cannot be equalized, if the value of the business, the $800,000 value of the business cannot be equalized by other assets, then the spouse keeping the business would most often have to pay payments to the other spouse. But there's all types of permutations or alternatives that can happen there. And the key will be to allow the other spouse to keep operating the business for the benefit of both parties. If you have questions about your business, how your business will be valued, how to keep your business, see the Bledsoe firm. Talk to the Bledsoe firm. We can help you with this.